So next up, we're going to hear from Corey Miles, who's going to talk to us about assessing value for different purchasers. Corey is a director of business valuation services at Taylor Leibow in Hamilton. Corey is a CPA and a CBV. Corey currently assists clients in valuations and related services for many situations, including mergers and acquisitions, litigation, family law, tax reorgs, and other various disputes. So at this time, I'd like to pass it over to Corey Miles.
Thanks, Louise. So what we're going to go over here is basically the different values that are ascribed by different purchasing parties. And you see the four of them that are outlined here are the notional purchaser. The notional purchaser is what we use when performing a business valuation under the CICBV standards. Private equity, strategic buyer, and family transfer are three different ones that will end up having different values ascribed to them. I do want to point out that we're not touching on differences that are due to terms versus price. You might see something go for $1 million. If it's $1 million up front, it might go for $1.2 million if there's a vendor take back for a portion, different reasonings for that. So we're not touching on that. It's mainly just what different purchasers are looking at and why they may pay a different value for it. So the first one that we'll touch on is the notional purchaser. And so under the CICBV standards, fair market value is the definition that we use. It's the highest price expressed in terms of cash or cash equivalents at which property would change hands between a hypothetical willing and able buyer and a hypothetical willing and able seller, acting at arm's length in an open and unrestricted market when neither is under compulsion to buy or sell and when both have reasonable knowledge of the relevant facts. So that's the fair market value definition, and that's generally what is used sometimes in litigation. Fair value, where maybe a minority discount isn't taken into account, might be used, but that's what we use in our valuations when we're performing them. The next slide.
You mentioned that there's a quiz afterwards, so I do hope that all of our viewers, took down the details of that definition, Corey.
Yeah, I'll ask them to touch each and every one of those points. And basically a notional purchaser, it's a standalone value of the shares. It's not taking into account any premium that a special purchaser may put on it. But what we're basically doing is saying that if a notional purchaser comes in and purchases a company, has to replace the owner, has to what kind of cash flows they're going to get going forward, and ultimately no special situations are incorporated into it. So that's just the standard that we use. Now we'll look at some of the different reasonings that other individuals may pay premiums or discounts as well, starting with private equity. The next slide here. So some of the reasons private equity might look to purchase a company, one of them being the company's underperforming. So they see that there's an opportunity. Perhaps it's a situation where private equity they might be in a certain industry. They've come out of a certain industry. They have expertise in that industry. And so they see that a company is being mismanaged. They feel like they can put in a management team, turn the company around. A lot of the time, private equity may be looking at doing a short-term rebuild of the company. It might be a 5-year plan that they have. They'll build it back up and then sell it for a profit. They might not be looking for a long-term investment here, but they'll eyeball certain metrics and say, well, this company is not being managed correctly. We have the expertise to get in there and turn this company around and sell it for a profit down the road. The business may be undervalued as far as their potential goes. So this can get into being mismanaged a little bit, but also maybe it's just not realizing all the opportunities that are there for the business as well. Other ways is you might see some businesses that are overstretched. They might be doing really well in one sector, and then other parts of the business are underperforming. So private equity will come in and they'll pay to purchase the business, but they're really then they might even finance it partway by selling off parts of the business itself that they don't really want. And really they're buying it for, something that could only be as much as 30, 40% of their revenue. but that's the piece that they want. They sell parts of it in order to finance the purchase. And the last one here, it's complementary to another part of their existing portfolio. So one that we look at sometimes might be if it's vertical integration. So it might be on the next slide, but it could be a book depot, like a book company that is looking at purchasing maybe a publisher or something like that. So they're kind of backfilling part of their business through this acquisition as well. In each of these, the three that were mentioned previously, they're not likely going to pay much of a premium. They're looking for opportunity. They might pay a bit of a discount. But if it's looking for vertical integration or something for an existing portfolio, then they might pay a premium on that. They may pay a small premium just as an incentive to get the owner on board with selling as well. But for a business that's in distress, you're likely going to see a discount to what's being offered there. It might be a fire sale. And again, it's just they're looking for opportunity and potentially just selling off parts of the business as well to finance it.
Corey, are you seeing a lot of private equity deals, a lot of private equity money flowing right now?
Well, during the pandemic, there was a lot of money that was put on the side. And so there was waiting for the opportunity to come out of the pandemic. And there was a lot of private equity activity that was going on immediately afterwards. Then interest rates have gone up a little bit. And so that slowed it down somewhat. But still, there seems to be certainly an increase in activity over the last year or so. And it's expected as well that potentially interest rates may be going down a little bit more, could be more money coming into play as well, and private equity could be picking up going forward.
Thank you.
The next one that we're looking at is the strategic buyer. The reasons why strategic buyers may look to purchase a company, it could be synergies that they achieve. So when you have two companies that are operating, maybe it's a competitor that they're looking at purchasing as well. They're in the same business. You might have administrative functions that may be duplications once the companies are integrated together. In that situation, when they're building out their cash flows going forward post-acquisition, that company is going to have more cash flows available to their strategic buyer than it is to, say, private equity that's purchasing as well. So the synergies that are being achieved can certainly help. One of the other ones would be the geographic reach. So if a company is operating solely, say, in the United States, they're looking to get into the Canadian market. Perhaps they purchase an existing company that's could be in Ontario, could be wherever they're looking at going. It's a lot easier to enter a market with an established business than to build it up from scratch. So a geographic reach could be a reason. Vertical integration, similar to what I was mentioning with the private equity, that you could have a manufacturing buying retail distribution function or something for a manufacturer as well. That way, what they're getting as well is that they're going to, prior to the purchase, they're not getting the profit margin from the distributor. They're going to then incorporate that in to get the vertical integration there. And so it saves them the cost on the manufacturer side while also getting the profit that is on the distribution side. And then entrance into an industry as well. So if you're looking at getting into a different industry, there could be a large capital outlay. This can be from a very small business to a very large business. You know, even if you were to look at why people buy dental practices, it's to get that existing customer base already. From that to, you know, whether it be an extremely large purchase as well.
Corey, are there any other reasons why a strategic buyer might purchase a business and pay a premium?
Yeah, it could be they could look to eliminate threats to their existing business. So an example could be, T-Mobile recently purchased Mint Mobile and paid a good premium on that, which worked out very well for Ryan Reynolds. But what they're doing there is it's kind of a dual thing. They're getting into the lower cost market further, but they're also eliminating a threat to their existing business in that situation. Sometimes, that's also what monopolies want to do as well, is to eliminate existing threats that come along. In the tech industry, you see it all the time, where smaller players get bought up for ridiculous multiples that it seems at the time, but it's in order to protect their assets and their existing businesses, sometimes more than they're even looking at growing as well.
Thank you.
So as mentioned, the strategic buyer, they'll have a different forecasted cash flow than what maybe the purchaser, if they're looking at their historic numbers or forecast, would have, mainly because they're going to get those synergies, or their market could be expanding further, and their gross margins might be getting higher. Now, the strategic buyer is not going to look at that forecast and say, I'm going to pay a multiple based on this forecast, because I'm going to have to be the one that goes and achieves the forecasted cash flow. So what will end up happening is there'll be a value that is in between what the cash flows would be without their strategic purchase for the existing business and what their strategic buyer sees. So there is a benefit to both sides. The strategic buyer will get that increase in cash flow going forward, whereas the seller is going to get a premium just for selling to their strategic buyer as well. Then the next situation that we have is the family transfer. So this one can sometimes be a little bit hairy as well. There's different kind of competing goals of the seller here, and three of them that are listed could be the legacy. The owners generally put in a lot of time, a lot of blood, sweat, and tears in order to achieve the business and build it up to the level that it's at. So they want to see that it succeeds going forward. They want the name to continue on, and they want the legacy to go on indefinitely. There's a lot of pride involved in it as well. Family harmony is another one. They want to ensure that, in situations like this, you might have different family members that are involved in different levels. So you might have the daughter that's the CEO in waiting, and you might have a son that's working on the line, and you might have another kid that isn't even involved in the business. So how do you equitably split up this business between them? You can't give them 1/3, 1/3, 1/3. Because whoever has put in the most effort will feel like they're being cheated a little bit. So it's the family harmony can be very tough to balance in this situation as well. And then employees can end up feeling like family. You might have somebody that's worked with the owner for 50 years, and really is invested in it. And at the end of the day, they may have really contributed to the growth of the company and to where it's at, and they want to reward them at the end. So they might give them an ownership stake for a discounted value in there as well, just as a thank you too. So the different weightings that the owner puts on these different competing goals will have a large effect on what ultimately the value that they transact at will be for. Many times what you see is for CRA, we have to come in with a value that is reasonable, so you're not conferring a benefit onto family members as well. But we'll try to have the benefit to the owner would be the lowest value in general, as long as that value is great enough to fund the retirement of the owner as well, so they have a comfortable life going on. So what might happen in that situation is we freeze the shares and then bring in the next generation to the fold. And so any growth going forward goes to them, but then the amount that's frozen as well can fund the retirement of the owner.
Corey, I'm sure many of our listeners today are potentially looking at family transfers. It's a bit of a loaded question, and you've alluded to some of this. What are some of the challenges that are unique to family transfers? And I think more importantly, how can some of that be mitigated for our viewers today?
Yeah, I think for a lot of the time in succession planning, what happens is that one thinks, okay, I'm just going to hand over the business to the next generation. And that might not be the ultimate right answer that goes in there. So what needs to be, there needs to be tough questions asked during the process, is rather than just defaulting to, hey, we're going to freeze the shares, we're going to bring in the next generation. When you look at stats as well, if it goes from the first generation, the second generation, maybe you're in the 50, 60% success rate that the transfer goes on. When you get into the next generation, the further down you go, the less likelihood of a successful transfer to the next generation. So if you're looking for family harmony, for treating everybody right, you might be in a situation where maybe you need to look at a third-party sale, or maybe you need to look at a management buyout, right, or something as well. You need the right person in charge of the business going forward to make sure that the cash flows from that business go on into the future, and that you can then split up the proceeds from it to the different family members. So I think that a lot of times the error is made in just the assumption that the next generation is ready to take over the business. And on the flip side of it too, the next generation sometimes doesn't want to take over the business.
For sure. And I think the only thing I would add to that is I just encourage people to reach out to their accountants, their lawyers, their advisors. Often have seen these things happen, and they know kind of what can go wrong. Your accountants also might be familiar with the family dynamics, and they can kind of help our sellers navigate some of those challenges as well.
Absolutely. So to kind of wrap everything up here, so the differences in values, other items that can come into play for coming up with different values, negotiating ability of either side certainly can result in a higher or lower value. Sometimes people want to, they might not be quite as acute at being able to try to negotiate and end up with a lower value for their company. In that situation, it's good to have a good advisor that will help you in the process. And then income tax issues as well. So when you're looking at it from a side of, if I'm going to sell a business, say for example, for $1 million, there's tax potentials where if you have your capital gains exemption, different tax issues, I won't get into it too much, but you may be able to almost get the entire amount tax-free. Whereas if you sell the assets out of the business, there can be significant tax effects that happen. In the one situation, if you're going to get the amounts tax-free, you might sell for a lower amount than if you're selling out just by way of assets as well, because you're ultimately looking at what's going to be in your pockets at the end of the day. In general, the highest price that's going to be paid is through a strategic purchaser. They have different reasoning why they can achieve higher cash flow, so they're going to pay a higher premium as well. The family transfer is likely going to see the lowest amount as well, because of the competing interests of family harmony, whether it's legacy and wanting to see it succeed. So there's different reasonings, there's different goals in the family transfer in general than a sale to a strategic purchaser. And when looking to sell, I think it's very important for the purchaser, the seller, to sit down and see what their goals are, what their needs are, and weigh each of these things. And in general, when you're selling, I always think that you should start the process at least 2 years before you're going to look to actually sell, because you want to get the company looking as good as it can to a potential purchaser, as well as knowing what you really want to get out of it at the end of the day, and what's going to make the seller happy as well.
Great. Thank you very much, Corey, for walking us through the different types of buyers that are out there and some of the considerations for each of the types of buyers. That was great.
Thank you.